fact, it's very interesting, Akhil, that I think in a lot of the communication uh, for the last, whatever, 15, 20 years, I think uh, a lot of people were saying equity is 3 to 5 years. And I'm very glad that you're pushing that number now to 10 years and beyond, because I think, the way markets are evolving, 3 to 5 years perhaps is not long term anymore to ride that whole cycle, as
Yes.
you very nicely
Yes.
explained.
Yes.
And I think that clarity is very important when anyone enters equity. My next question, you've been an equity-centric mutual fund house from the very beginning. And however, when a new investor, any young person who's listening to you wants to enter, and of course, we've seen the whole debate around debt funds. We saw the tax incentive going away. And then there is this debate that should you still invest in a debt fund, or should you go into a balanced fund, which gives you a bit of debt and equity? So I'll keep that debate aside for now. But for a new investor at this point, uh, what, according to you, would be a good category to start with?
If I get your question right, if this is for absolute virgin investor, first time coming into
Yes.
equity mutual funds, then large caps clearly is the best way to start with. Buy into one amongst several good large cap products. You can also start with a Nifty 50 index fund, but if you want to come in for outperformance and alpha, then come into one or two good large cap funds where 65% and more is invested into the top 100 companies. Essentially, what will happen is that you are buying into India's most pristine blue chip companies, which have been in business for several decades. They have a great track record, very solid, proven ownership and management, sustainable growth, and generally these stocks are relatively lesser volatile. They fall less and they grow at a reasonable good pace. So for first time investors, the first thing to consider is that you should protect your capital. This is very, very important. So to protect the capital, you come into companies which are relatively less volatile, which will typically be the large cap businesses, and expect a 10-12% kind of a return profile over a longer term period. Like I said, you should look at 10 years, but for large caps, I would give it to you that, okay, give it a 5-year period, right? So for large caps, maybe 5 years is fine, but that is a good starting point. And maybe in due course of time, then you can move into a flexi cap fund where you get some exposure to mid cap and small cap, and then you take your journey forward as you get your experience.